is our myth buster today. We are going to jump into mortgage insurance. And Darcy, the myth busting question that we're going to talk about today is mortgage insurance is just a big, fat, filthy waste of money. That's what mortgage insurance is.
That is something that it's amazing to me how many people, like you say, mortgage insurance, and they're like, oh, I don't want to have to pay that. And they get all like, I have to put I have to put 20% down or whatever in their perception is,
Right.
because I cannot pay mortgage insurance.
Right. Yeah. Mortgage insurance has definitely taken on a life of its own
Super
and a
negative.
perception on the street that is 110% incorrect. So mortgage insurance is not a waste of money. And here's why, my friend. Mortgage insurance, I meant to look this up before the show, has been helping people with less than 20% buy a house. I want to say in way back when until the 50s or earlier. But mortgage insurance is the tool that allows us mortgage lenders to feel safe and secure leveraging on a house that doesn't have a 20% down payment, right? Back in the day before the 80s, you couldn't buy a house without 20% down, right? That was it. And that's why our parents are still like, oh, you got to have 20% down. You got to have 20% down. No, you don't. You have to have a little bit down. If you're going Fannie Mae or FHA, that's like 3 or 3.5% down, right? And there's some down payment assistance programs that will allow you to do zero down and VAs out there. But mortgage insurance is a tool. It's the best tool that you can put in your tool belt if you don't have a 20% down payment. And here's why. The gal that I'm referring to was at one of my first time homebuyer classes, and she wanted to buy a $700,000 house. And she says, I only have 10% down. I said, that's awesome. You can get into a house. You can do it right now. You can take that $70,000 on that $700,000 house, get into a house, and you will be paying mortgage insurance because you're not putting down a full 20. And she looked at me like I called her kid ugly or something. And she's like, oh, I am not going to pay mortgage insurance. And I was like, oh, well, why is that? And she goes, mortgage insurance is a waste of money. And so I played out the math for her. I said, okay, how long is it going to take you to save up that other $70,000? She goes, oh, it's going to take me 2 years to save up the 70,000 bucks. I said, okay, so in another 2 years, and keep in mind, this was 2018 when I had this conversation with her. 2 more years, 24 months, you're going to save up that 70,000 bucks. Awesome, great. So that's $700,000, assuming at that point I was being conservative with the 5% increase year over year, right? So at 5%, that house is going to increase 35,000 bucks. And then the next year it's going to increase almost $40,000. So now that $700,000 house is going to cost her $775. And now we have to have a 20% down payment of $775, which means she needs to come up with what is that? Another I should have had the math ready. She's got to come up with another 10, 20,000 bucks, and she won't have it, right? Not only is she going to have to come up with more money, right? That's what people think. Well, okay, I can find that a extra $20,000, but what she doesn't realize is she's missing out on that $70,000 equity gain in that house in that 2 years. And then what the majority of people don't realize, depending on your credit score, and mortgage insurance varies greatly across credit scores, folks. So the better credit score you have, the more inconsequential mortgage insurance is, right? I priced her out. She had a great credit score at 765, right? Priced her out mortgage insurance for a 10% down situation. Her mortgage insurance literally was 56 bucks a month.
That's nothing.
56 bucks a month. So I tell this story because mortgage insurance is a powerful tool because the majority of Americans cannot save at a fast enough rate to keep up with the market, right?
And on top of that, though, even if you have the 20%, I'd rather take that extra 10%, that $70,000, and invest it another way that's going to get me a heck of a lot more money.
Yes.
And be able to pay the $56 extra.
The answer is yes. You know, at that time, 2008, we ticked up to high threes, low fours. So that's another opportunity cost that I definitely implore all of you out there to go out and say, hey, before I dump this huge fat wad on a new house, and a house is a dead asset, right? Once I dump this $140,000 on a house, what are you going to get for the utility of that money, right?
Yep.
Your cost of funds is at that point 4%. Today it's more like 6%, right? 5.75, 6%. But can your money perform better in different avenues, in different investment vehicles, in another house, right? You could turn around.
Absolutely. Or
and go
in our case, yeah, we could have put more down, but I wanted to save that cash to fix up certain things in the house.
Correct. That's a great
Which isn't going to necessarily make me more money right away. It will long term, and it'll make my comfort living here a lot better.
Yeah, this is my passion, because like as Americans, we tend to not think in great financial senses, right? We tend not to think about how I can deploy my money in other ways.
Yep.
The in my opinion, outdated American dream of pay off your house, pay off your house, pay off your house, although it's morally good, it may not be the best utilization of your capital. So especially with all those folks out there that have hundreds of thousands of dollars worth of equity that they're selling their house and they want to roll into the next one, do me a favor, do Darcy a favor, do everybody a favor, and yourself, most importantly, sit down with your financial planner. Sit down with your financial planner with that hundreds of thousands of dollars worth of equity that you're going to roll into your next house. Because here's the thing about that dead asset that I said a house is. A house, to get the money back out of it, is very expensive. You have to do one of two things. You either have to go to Darcy and sell the house, or you have to come to me and refinance the house.
Right.
And bare bottom's closing cost of refinancing a house is somewhere between $5 to $10,000, depending on your loan amount, right? So to get equity back out of your house, and that's not taking into account where the rate environment is at the time of refinance, right? So if you need that cash out for whatever it is, you're going to have to pay a pretty penny to get it back out, or sell the house, and then you no longer have the house as an asset that's currently appreciating in value, as well as you're paying down the principal balance every year or every month. So